Good evening and welcome to Real Wealth Development's webinar tonight. So happy to have you here. I'm Kathy Fettke, and today we are going to be doing kind of back to the basics with Syndication 101 with our attorney, our syndication attorney, Mauricio Rauld. And we're also going to talk about our latest syndication offering, which is our new construction build to rent community in San Antonio. And if you have been interested in this syndication, time is running out. We just have, I think, just a little bit, about a couple of weeks left for you to be able to invest in that project. And we don't want you to miss out because that's happened in past projects where people ask us like the next day that it's been shut down, if they can be a part of it, not shut down, but with the doors closed basically. And I'll ask Mauricio today that question of what happens if somebody wants to invest after the deadline, and he'll give you the answer there. All right. So Mauricio Rauld is owner of Platinum Coaching. So we'll just go to the next slide here. This is our general disclaimer, which I am not going to read out loud. I would lose all of you very quickly. Thanks, Mauricio, for making me post this. But we've got it up here for you to see. Basically, we're going to be talking about securities here, and that's why we have a securities attorney here. Again, this is the disclaimer that we have for any presentation we have on our syndications. All right, so let's get into it. And again, welcome. I know I see some people still coming on. We're so happy to have you here. We're just, doing Syndication 101. What is a real estate syndication? And I'll tell you, it's so funny because I learn stuff every time every day. So even if you already know about syndications, you may just learn a few things here today. So it is a group investment structure where multiple investors pool capital to acquire real estate, typically led by a sponsor operator which can be one person or a group. Better if it's a group, because if something happens to one sponsor, well, kind of stuck without an operator. But that team basically finds, manages, and executes a deal that is too much for one person to do. These are bigger deals, not our single family rentals that we specialize in at RealWealth. This is apartments and build to rent communities that take a lot more effort and maybe not so passive unless you're a passive investor in it. So that brings us to the investors, the limited partners who provide the capital, and they're able to receive passive income and potential appreciation. So you've got the GP, the general partners who manage it, run it, are liable for things going wrong, and then the limited partners who invest. And Mauricio could talk about what limited partner means. Okay, next slide. So the key terms, again, in a syndication is the general partner. As I said, that's who manages the investment. The limited partner, they're passive investors who provide capital. And that means limited liability. I'm not going to talk legal talk. So anyway, equity split, percentage of profits shared between GPs and LPs. Typically you'll see a 60-40, and you always have to ask who's getting the 60, who's getting the 40. If with 50-50, it's a little bit more easy to understand, but 80-20 in some of our early deals, we did 80-20 splits. Usually the 80% goes to the investor. In our case, it went to the sponsor because we were giving such a massive preferred return at the beginning, which brings us to the waterfall structure, which defines how those profits are distributed over time. The hold period, the expected duration of the investment, what an accredited investor is. It's an individual or entity that meets specific financial criteria set by the SEC, allowing them to invest in private securities offerings such as real estate syndications. And then the PPM, private placement memorandum, which basically describes what you're investing in the business plan. Okay, next slide. So a preferred return, people get very confused about this. I was even on a podcast recently with someone really well known in the industry, and that person kind of didn't really understand completely what a preferred return is, because the way they put it was the guaranteed interest rate. That is not what it is. So a preferred return is a minimum return distributed to investors before the sponsor shares in profits. But it is important to understand that, at least the way I understand it, is that preferred return is part of profit. So if there's no profit, there's no preferred return. It's different than an interest rate or a loan. Typically ranges from 6 to 8% based on the deal. As I said earlier at Real Wealth, we just do things a little differently, mainly because I was one of the first people syndicating back in 2009, and I didn't have anyone telling me how to do it. And it just made sense to me that if investors are putting up most of the money, that they should get most of the money, I guess, you know. So it was like have the preferred return be high. That way it incentivizes us as the sponsor to meet our deadlines, our targets, because otherwise there's not much left for us as the sponsors if the investors are getting front loaded with the profits. So what is the difference between a 506C and a 506B? We get this question a lot. And a 506B allows up to 35 non-accredited investors. So that's that mean well, we'll talk about what an accredited investor is. And but you can only present it to people that you already know, that you have a pre-existing relationship with. So I couldn't go on the podcast or on Facebook and talk about a deal we're doing because that would sort of open it up to the public. It has to be private. And you have to prove that you know these people. I couldn't just meet them at an event, shake their hand, and now I have a pre-existing relationship. I need to have a little bit more substantial, like know who they are, where they live, how much money they make, and I'm not, but how much, you know, are they capable of making this investment without leaving them in ruin if it doesn't work out as expected. 506C is for accredited investors only and allows public advertising and marketing. So that is why most of our syndications lately have been filed as a 506C, because I am so outspoken and it could be dangerous for me if I'm on a podcast. I suddenly start talking about a syndication, like, oops, I wasn't supposed to talk about that. So we just don't want to blur any lines, and that's why we filed as a 506C. But we've had a lot of non-accredited investors saying, can we please participate? So we're going to talk to Mauricio about how we can do that.
I can take it from here if you want.
That would be great. I just didn't see your camera, so I didn't know, I didn't know.
No, you're good. So let's go back a little bit on some of the terms. I know you wanted
Thank
to skip
you.
over
Thank you.
those terms a little bit, just because obviously there's
I'm
some of
so
these are
glad. I'm
legal.
so glad. Yeah,
So these are legal terms. So I mean, I think you did it. I mean, obviously the GPLP, I think that you explained that really well. Really, the GP in this case, Real Wealth, Kathy, it's really the person who knows who knows what they're doing, right? It's the person who's actually putting this deal together, who's
Yep.
doing all the work, who's finding the deal, vetting the deal, doing the due diligence, doing pretty much everything. And the limited partners are you guys on this webinar, potentially on this webinar, that you're simply providing the capital in order to go do this, but you are limited. The reason we call it a limited partner is because your liability is limited. So your liability stops at the amount of your investment. So you invest $100,000 or $150,000, whatever the investment amount is, that's the most money that you could potentially lose because you have limited liability. It also means you have limited control, or really most of these cases you have almost no control. So that's why it's a passive investment, because once you make the decision to invest, once you've vetted, and we'll talk about vetting sponsors, but once you've vetted the Real Wealth team, then you make the decision, hey, this is a good deal for me. I think it's a good one. You make the investment and you are literally passive at that point. You're along for the train ride. Real Wealth and the sponsor will do, updates on a quarterly basis, keep you up to speed, but you're not in there making decisions and you don't want to make decisions, by the way. From a legal standpoint, the minute you start, because I've seen that sometimes with syndications, that limited partners want to have a little bit more control, especially in smaller ones. You lose your limitation of liability if you get too involved in a deal. So you don't want to be involved in a deal. That's not what this is for. This is really meant for you to put your dollars to work, invest in somebody else, and you then continue to do what you do best, which is whatever your current job is or whatever your business is. Accredited investor is an important term as well, because that is a legal term, and depending on what exemption people use, it is very, very relevant. And certainly here in this particular investment, it is limited to accredited investors only. And so let's figure out what that means. An accredited investor generally means a high net worth or high income individual, right? So on the net worth side, it's somebody who has $1 million or more in net worth, excluding their primary residence. The reason for that is because everybody here in California became an accredited investor back in the last the last cycle. And so at some point they removed that. And so it's excluding primary residence, $1 million or more. And then on the income side, if you're an individual who has earned $200,000 the last 2 years and you have a reasonable expectation of earning 200,000 or more this year, you are an accredited investor. And if you want to combine your income with your spouse, that number goes up to 300. So maybe, one spouse makes, let's go with 150. Then the other spouse would have to also make 150 in order to make the 300. So 150 and 50 is not going to cut it. The private placement memorandum, I've got a quick story on that because I think it's a good analogy, not a story, but an analogy. But I always tell the story really of I have terrible teeth. And so I've had oral surgery 1,000 times. And every time I go in to have oral surgery, even though I'm only going to be under anesthesia, or they put me under actually for a couple of minutes, they give you that medical consent form. Anybody here who's had surgery before has probably recognized that yellow medical consent form where they kind of describe all the risks of the upcoming surgery. In my case, it's a relatively minor thing. So they tell me, hey, I could have, some bleeding as a result of, maybe my wisdom getting my teeth taken out. I could have an infection. I could die from the proceeding. I mean, literally, they list all the potential ways that this particular surgery goes wrong. I will then sign off on that. The doctor signs off, and boom, you get the surgery done. That's really what a PPM is. It's on the legal side. It's just a document that reflects all of the risks and potential risks, even though the sponsor doesn't necessarily, they don't actually think that's going to happen, but we want to disclose all of the potential risks, all of the information for the investors so that the investor can make an intelligent decision whether this is a good deal for them or not. They can analyze the risk. They can say, yes, I'm comfortable with this risk. No, I'm not comfortable with this risk. This is the disclosure document that outlines all of that stuff. So it's a very, very important document. That's the one that all the lawyers draft. It's very, very important for you to read that document, even though it's a good cure for insomnia. I would highly recommend that you really pay attention to the PPM. That's where all the waterfall structures are going to show up. That's where all the equity splits. Kathy talked about preferred returns. Like all of that language, all of those terms are going to be in a private placement memorandum. So it's really, really important to look at that. I think the next slide we talked a little bit about the preferred return, and Kathy, you hit it right on the nose. A preferred return is not a guarantee. Honestly, if you ever hear anybody say this is a guaranteed thing, you should probably turn around and run the opposite direction because nothing is guaranteed. And certainly a preferred return is not a guarantee. A preferred return simply says that the investor is going to get all of the available cash or profits for the cash flow. They're going to get all of it until they hit that preferred return. So in the example on the slide, let's just say it's a 6% preferred return. That means the investors get all of the money that's available until they get a 6% return on their money. So if I put in 100 grand, I'm going to get all the money until I hit my $6,000. And then anything above that will start splitting in a different way according to the waterfall. So it's never a guarantee. In fact, not a lot of time, but sometimes the project, especially on a development deal, maybe the project doesn't even spit off 6%. So if the project only spits off 3%, you're going to get all of the money available, but you're only going to get 3% because that's just how much is left over. And so a lot of time that gets rolled over to the next year. But again, it's not a guarantee. So just always keep that in mind. It's just a preferred allocation. The investors get paid before the sponsors, essentially. And then we get into the kind of the legal stuff. I don't want to bore Paul. You tell me how much I should bore folks on this, but it is important to understand a high level. So I'm going to keep this really high level.
We get a lot of questions on the 506C and the 506.
Perfect. Okay. Yeah, I'm happy to explain it. I think I've got an easy way to digest. As Kathy knows, I'm known as one of the few attorneys that actually speaks English. So hopefully I'll be able to explain this in a way that is easy to understand. But look, at the end of the day, when a sponsor is raising money for any deal at all, they are in the business of selling securities. When you think about it, you as the investor, you're basically buying a piece of the company, shares in the company. In this case, it's a limited liability company. So you guys are actually going to be members of an LLC, members of a company. So the company is issuing shares to you, right? And so that is a security. It's like you're buying shares. So it's somewhat similar to buying stock in Microsoft or Google or Yahoo, whatever. It's like you're actually going to you have ownership in the company, right? So the sponsor is issuing that security. And when that happens, you have to comply with securities laws, obviously. And the rule is essentially that when you are selling securities, you have to either register that security with the SEC, the Securities and Exchange Commission, or we have to find an exemption to registration, right? And so anytime you hear 506B, 506C, Sometimes you hear Reg A, all these things out there. There are the exemptions because nobody wants to register. Nobody does register the syndication because that's going public. That's when, Facebook decides to go public and does an IPO. That's what registering means. And obviously these are private offerings. We no intention of going public. We don't have time to go public, to be honest with you, because public takes 2 or 3 years to get through the process. And, you get in a contract to buy a building, you've got to close in 6 months or 4 months or whatever. So we don't register syndications or we don't register securities, but we do look for the right exemption. And 506B and 506C are 2 of the exemptions that are out there that happen to be the most popular exemptions out there. They're very, very similar exemptions with a couple of interesting or important pivot points, but let's just go through one by one. So 506B is actually probably one of the more popular exemptions even between these two. They allow you to raise an unlimited amount of money, so that's always a plus. And it allows you to take up to 35 non-accredited investors, right? So this is great for, especially if you're just starting out or you've got your friends and family and, inevitably, Uncle Bob and Aunt Karen, they're non-accredited. You're allowed to take up to 35 of those non-accredited investors, which is one of the reasons it's super popular. The issue with 506B or the limitation of a 506B is that you cannot advertise or generally solicit your deal. So you cannot go on podcasts like Kathy just mentioned. You cannot go on social media. You cannot, just go to seminars and webinars and start just advertising the deal left and right, because that would violate the prohibition against advertising. Because at the end of the day, 506B really, it's the original exemption and it's meant to be a private offering. It's meant to be private for people that I already know, that I generally have a pre-existing substantive relationship. And so if I have a pre-existing substantive relationship with you, then by definition, I have not advertised, I've not generally solicited to you. And so that is the 506B exemption. So it's used a lot. It's used a lot for people just starting out because, again, they have their network, they have their group of people, and inevitably somebody there is not accredited. And then as people start to grow and scale, they need to sort of branch out a little bit and get to expand that a little bit more and get to people they don't know and they want to go advertise. And so that's where 506C comes in. And 506C is actually a relatively new exemption. It only came into the books, I guess maybe it's almost 10 years ago now, but back in 2013 is when it came out. So before 2013, all these years, decades, it was just 506 is what it was. But about 10 years ago or in 2013, I guess it's 12 years ago, man, where does the time go? 506C came on, which they actually allowed you to advertise, even though it's a little weird, even though it's still considered a private offering. It's a private offering that you can publicly advertise, which doesn't make a ton of sense, but it is what it is. So you are allowed to publicly advertise. You can go on social media, you can go on podcasts, you can go on television, you can take out a Super Bowl ad, you can do a webinar like this, you can pretty much do anything you want, with some limitations on disclosures, which is one of the reasons you have the disclaimer language in there. But essentially, you can talk to people that you don't know, that you can meet at conferences, and you can expand your reach, and you can offer these securities to people you do not know. Now, that comes with a sort of a price tag with it, so to speak, and the price or the trade-off is that you are not allowed to take any non-accredited investors in exchange for that privilege to be able to advertise. So 506C allows you to advertise, but it limits you to accredited investors only. So only the high net worth individual, income or net worth, that is who is limited in these deals. And in addition to being accredited, the sponsor must take what's called reasonable steps to verify that they are accredited. They cannot take their word for you. So RealWealth can't just say, oh, Paul, you say you're accredited, cool, you're eligible for this deal. No. We have to take reasonable steps to verify, and that usually takes the form of maybe it's requesting some tax information or requesting a letter from your CPA that knows you well and can verify that information. So there are ways to verify that, but that is a requirement of the exemption. And if they don't follow that requirement, they're not allowed to issue the securities under 506C. So that's kind of the main bit. So basically, they're identical exemptions. If you look at all the bullet points of each exemption, they're actually identical. You can raise an unlimited amount of money. The pivot points, though, the difference is on one, you can advertise, and one you cannot. So 506C, you can advertise, 506B, you cannot. And then the other pivot point is accredited versus non-accredited. In one of them, 506B, you can take non-accredited. In a 506C, you cannot take non-accredited. And that's kind of the big difference between the two. So hopefully that answered that question. In In terms of, I think the next slide was how syndications are typically structured. So if you've never been in a syndication, the way it happens is the properties themselves or the property itself is owned by an LLC. So the title to the property isn't an LLC usually. Technically, it could be in any entity form you want, a limited partnership, or even technically a corporation, I guess, but there are tax issues there. So most people these days use a limited liability company, and that's the entity that's going to actually own the property. And then the limited partners, along with the general partners, they're going to be the owners of the LLC. So from a structure standpoint, the limited partner owns a piece of the LLC, and then the LLC owns the entire property, right? And so you're not technically owning a direct piece of property, but you will be owning a piece of an entity, an LLC, and the sponsors at the end of the year will file a tax return on behalf of the LLC, and then they will issue to every single member or limited partner of the LLC a tax document called a K1, and that K1 kind of outlines what the profit was for that year, and then you take that profit number and you put it on your personal tax return, and that's how sort of that thing works. But it truly is a passive investment. I mean, when people say, I've seen a lot of people say, well, there's no such thing as a passive investment. Even real estate, you got to deal with people, even if you have managers. But really, I'm an LP investor, and that is truly a passive hands-off investment. Once you make that decision to invest, once you've vetted that sponsor, which I think is coming up next, we'll talk about in a second. But once you do the work up front and you write that check, it is literally passive. You're there for the ride. You get updated every so often, usually on a quarterly basis. You get the checks usually on a quarterly basis, but there's no decision making on your part if things aren't going well, or if the toilets break, or the contractor is delayed, or whatever issues come up. The general partner, the sponsors, are the ones that are actually managing the deal and running the day-to-day operations. And so that's how, from a structural standpoint, it works. And then essentially all of the profits that the project generates, in this case, the real estate generates, those belong to the LLC because that's the owner. And then from the LLC, it gets distributed according to the particular waterfall, the preferred return, and then whatever the splits are. And so that's how sort of the cash flow will flow as well. It goes from all the profits go to the LLC first, and then from the LLC, they get distributed to the bank accounts for each individual investor, whether they're an LP and a GP. And the way the GP generally makes money for doing all of this work is there's some fees that are charged upfront just for all the work that goes involved in finding the deal and doing the due diligence and getting the loan and guaranteeing the loan, all the kind of upfront fees. Then there's an ongoing fees that happen during the project itself, which we call asset management fees. So you're while you're managing the asset, there's a fee involved there. And then honestly, the sort of the big sponsor, how they make money is really on the back end, to be honest with you. It's on the profit split at the end, either during a sale or a refinance or whatever. That's where you split the profits, and it just depends on the waterfall and how those profits are split. And I know Paul will go into that in a second. And the next slide is super important, and I'm glad I saw that here because I talk a lot about this myself, but your number one job as the limited partner is to vet the sponsor and make sure you're comfortable with the sponsor. Not all deals were created equal. There are some deals that have really excellent sponsors. I would venture to say, I know Kathy for many, many years, Kathy and RealWealth, excellent sponsors. And then there are first-time sponsors and sponsors that don't necessarily know what they're doing. And so it's super important to spend, I don't know if you guys agree with me or not. We can circle back in a second here, but I tend to say almost 80, 90% of my work as a limited partner is on vetting the sponsor and the operator. How long have they been around? Are they qualified to do this deal? Can they pull it off? What's their track record? What does their team look like? Who's on their team? Who's going to be doing this? How many years of experience? I mean, you really want to dig into the specifics of the operator, because if you can have a really amazing project, and if you have a substandard operator, the deal's going to not go well. On the other hand, you could have a deal that's not the greatest deal, or maybe it's having some challenges, but a really good operator can really pull that through. And so vetting the sponsor and operator, I think, is 80% plus of what you should be doing as an LP. Analyzing the market's also a big thing. I talk about all that. So that's definitely the second thing, because, I mean, think about it. You want to make sure your interests are aligned with whatever the sponsor's doing. I mean, if you hate a particular market, hey, I would never invest in this particular market, and this happens to be a deal in that market, then it's not a good alignment for you, right? And so You want to make sure you're comfortable with the market. You've either already analyzed the market, so you like it, or maybe it's been presented to you and you can do your due diligence on the market and say, look, I really like this market. Because market's a big deal. Like a market can lift all boats or crash all boats. So you can have an amazing deal if it's in a market that's going in the wrong direction. It can help you, and vice versa. You could have a deal that ordinarily would have been a break even or struggling, but because it's in a great market, it'll just take it with you. Obviously, you want to then review the deal structure, and that's where you really want to review the PPM primarily. The deal structure, there's going to be a section in there called sort of a waterfall or the distributions that'll outline very, very clearly the order of how things get distributed. So there's going to be two components to it, right? There's going to be the cash flow that gets generated from the project. How does that get distributed? And then at the end, when you either refinance or you sell the project, once you pay the lender and pay all your closing costs or whatever's left over, how does that get distributed? So that's something you want to pay very close attention to in the private placement memorandum. And then obviously the asset itself, at some point, the asset's important. I've talked to a lot of people who think sort of the asset might be a little bit more interchangeable because the sponsor is the most important, but you definitely want to assess the property and the asset and make sure that you like the asset class, you like the property itself. And look, I know it's going to cure insomnia, but you want to review all the legal documents. Very, very, very important. And honestly, you might even get away with just doing that the first time because sponsors will have similar documents. So I would just encourage you guys, if you've never done a deal with RealWealth, just suck it up, read the documents, get it done, and then the second time around, it's going to look a little bit more familiar, and it may be the waterfalls change a little bit, and so it'll get easier and easier. But the first time, you want to make sure you're super comfortable with the legal documents, and then obviously understanding the risks. This is a pet peeve of mine over the last few years: is that you don't want to just look at the returns, you don't want to just look at what the projections are or whatever. You want to really look at the risk adjusted returns, right? Because again, if you're comparing two deals, one deal is a really reputable sponsor and a great sponsor versus a rookie. The rookie who's never done this before might be offering better returns on paper, but when you adjust for the risk of having a syndicator or a sponsor that doesn't have as much experience, or maybe they're in a new market or whatever the circumstances are, you've got to factor that into your analysis of the risk. So don't just look at numbers and say, well, hey, this deal's giving me X return and this one's giving me more, I'm going to go with this other one. You really want to look at all of these factors. And again, 80% for me as a sponsor. Did I miss anything, Paul? Anything else you want me to touch on?
No, I think you covered it all pretty much. A good overview of basic syndications there.
Yeah, I think we've got everything that was here on the slides.
Yeah, I'm going to run through our deal, Wild Pine San Antonio, that we have, and we have a few questions. So I'll go through this fast so people could get their questions to you. This is our active syndication deal. It is a 56 unit, 20 duplex built to rent community in San Antonio, Texas. It'll be managed by our experienced property team, RealWealth, and then one of our top vetted property teams in RealWealth in San Antonio, Invest 5S is the other sponsor. We're offering a 12% preferred return, which is higher than most our competitors. As Mauricio pointed out in some of his slides, it's typically 6 to 8%. And we are offering 50% profit sharing. And that is no waterfall structures. So it is 50% the entire time. For the distributions, 100% available distribution cash goes to investors until they receive amount equal to their adjusted capital contribution, and then they receive the preferred return. And then lastly, we will distribute anticipated profits. It is a 5 to 6 year hold. We do have conservative underwriting, which we'll touch upon. The minimum investment requirement is $50,000. And it is a 506C offering for accredited investors only. I'll run through this high level, our business plan. One, we have already acquired the land. So we have purchased already 9.6 acres. We are underway with starting construction. We are working on the construction loan as we speak right now. So there's a term sheet in place. As I said, we're anticipating to build 56 units over 36 to 40 months in 3 phases. Phase 1, all site work. Phase 2, 14 duplexes. And then the next phase 3, another 14 duplexes. While we're under construction on the second round of duplexes, we'll be pre-leasing the first 14 duplexes. Our lease rate that we're targeting is $1.52, which in lines with comps in the market. Other 3-bedroom comps in this area of San Antonio go for $1.49 to $1.79 per square foot. Once construction is complete, we will then go out to refinance the loan and go to perm debt. So once we have it completely occupied and built, we'll take out the construction loan and move to perm debt. We will then hold the property for 1 year and then sell it either in year 5 or 6. We do have 2 options on our exit strategy. We could sell it as a bulk portfolio targeting larger institutional investors for around a 5.15 cap rate would be the target, or we could sell them off 1 duplex at a time to retail buyers. So 2 exit strategies. So overall, the plan is to build the 56 units. Once it's built, we'll refinance. Once we refinance, we'll hold it for a year and then sell it. The property is located still in San Antonio city limits, but outside the city, about 20 miles. Great location, right by the highway, close to shopping, restaurants, office, and a lot of retail in this general area. This is just an overview of the site. You'll see here, surrounded by a lot of Class A multifamily. And then you also have single family homes that range from $350,000 to $450,000 in the surrounding area. I'll touch on our conservative underwriting. One approach that we took for this deal was we were very conservative in our underwriting. The total project cost is around $12.5 million. That number does include contingent soft costs, hard costs, and financing contingencies all in place. We also added some additional time. You know, the builder mentioned this could be built in around 28 months. We're given around 36 to 40 months of interest carry. Also with our underwriting, I'll touch on in a second, the interest rate that we did the underwriting at is like 9.25. We're going to be at around, anticipated to be around 7.75. So right off the bat, we could be saving around $500,000 in interest reserve from the start. The operating expenses, same thing. We added some additional costs in the operating expenses, and it is under a builder 1-year warranty. We also add additional payroll in case we have to bring in some third-party vendors or additional management needs in place. For annual lease rate increases, we only use 1%. You know, the market typically is around 3 to 4% historically. So keeping it at 1%, we feel very conservative that we'll hit the rates. Also, we built in concessions if we need to give away free rent. We have bad debt in case someone doesn't pay on their lease. And then we have a 5% vacancy in place as well. And we have expenses increasing 2% each year over year. So getting into the returns, you'll see in this column, the underwriting returns. This is where in the PPM, all the returns are listed. We did update them just to reflect the new construction loan term sheets. So right off the bat, as I mentioned, we are sort of increasing returns just by having a higher LTV and a lower interest rate than pro forma. So very strong returns on the investor projections. IRR is around now 19.18%. The equity multiplier is over 2. So you can see here on the right, an example we give is if you invest $50,000, your anticipated preferred return and anticipated profits. So basically doubling your money in around 5 years to 6 years upon the sale. And then investor profits around $3.5 million. And as I mentioned, that is 50% of the profits, no waterfall structures in place, so that remains at 50% the entire time. Financing assumptions that we're using. In the underwriting, initial underwriting, we have interest rate of 9.25 and 71% loan to value. We currently have a term sheet in place, and the construction documents are being drafted, loan documents, for a rate at 7.75 and an LTV of 75%. Right off the bat, that reduces the amount of equity we need and amount of interest reserves we need to carry. The refinancing, same thing. We did it to underwriting to today's market. We didn't try to predict what's going to happen in 3 years. So these are pretty conservative rates that we feel that we'll definitely get in today's market. Same thing on the sale exit. We did the underwriting based on what we see in the market today, not 5 years from now. So the ultimate goal would be to sell the project for 18.2. We're going to build it for that 12.5 or less, and then anticipate to sell it for around that 18.2. One thing to point out is the developer is selling these exact product already in today's market for $300,000 to $325,000 a unit. So that's how we came up with the pricing. We do anticipate to see that appreciation. So we feel that this number is very achievable. Distributions, I'll touch on real fast. This is important as we structure these a little differently. First, we return the adjusted capital to the investors. Once the adjusted capital is down to zero, then we distribute the preferred return. Once you receive your preferred return, then profit sharing, the 50% profit sharing is distributed. We do it this way so that the sponsors do not receive any profits until one, the capital has been returned and the preferred return has been paid off. This to point out, this offering does expire on March 31st at the end of this month. So we are winding down with the last time to potentially invest in this deal. If you have any questions, you can email syndications at RealWealth, or you can email me at paul@realwealth.com. And we're opening it back up, and I'm going to stop sharing. And we could open up to questions here.
There's a great question in the chat. There was kind of a legal thing that I wanted to kind of clear up a little bit about the GP. Or do you want to do
you just want to start at the top here?
Yeah, so the question is, Jennifer asked a great question, which is, can you please specify who the GP is in this particular syndication? Is it Kathy, Mauricio, a corporate entity? It's definitely not Mauricio. Let's put it that way. I wouldn't know the first thing. You definitely do not want me managing and being involved in this project. No, I'm the legal attorney. I'm the counsel. I'm the one who put together the insomnia killing documents that you're going to read. My firm, Premier Law Group, put those together. But it's a great question because let me answer the question first. It's primarily Kathy and her partner Clay, but it's sometimes challenging because we do use corporate entities. It's sometimes it might be a little bit difficult to figure out. But generally, so you have RealWealth Development, which is Kathy's company, and they're partnering with what's the name of Clay's company? Invest, right?
Invest.
And so what we generally do to keep things simple is generally the LLC needs a manager, and so we generally create a new management entity, a brand new company that's going to be owned by the two GPs through their entities, right? And then just from an asset protection standpoint, the distribution or the ownership is going to be held in different entities, right? So Kathy has two separate entities. One's RealWealth Development. And then if you look at the documentation, and it's all in the PPM, you've got, I've just lost it. What's the name of your Class B focused? You just had it up there, the percentage splits. So those are just entities, but they're all ultimately all controlled by the actual GP's responses, which is really Kathy and Clay.
Next question is the income from a syndication tax advantage similar to directly holding rental properties? For example, is the investor's taxable income reduced by depreciation?
I know I'm going to answer this, although I am not a tax professional, so don't definitely check with your tax professional. But
Legal
yes,
disclaimer.
one of the general, and I'll talk in generality, one of the general beauties or benefits of the syndication model is that all of the tax benefits do flow up as if you owned it individually, right? So all of the tax and the bonus depreciation and all the tax benefits will go to the LLC, and then that LLC will issue your K1. So you're going to get that percentage ownership piece of that bonus depreciation or any other tax benefit that you would enjoy as an individual investor. You get to enjoy that same depreciation and tax benefits on the group model.
But I mean, it all is based on what's written in the documents, right? Like a sponsor could write in there, no, I'm going to take all the tax benefits. They could do that, right?
They could
Or does
try. I mean, ultimately, the IRS will, look at that, and from what I've told, it's like, hey, it is what it is. But yeah,
yeah,
I've seen some sponsors try and do something like that, but yeah, generally, it'll map to whatever ownership percentage you have.
that makes sense. All right, let's go to the top. If I hold the LP ownership in a trust, does the trust have to qualify as the accredited investor or the individual trustee, grantor, beneficiary?
Yeah, assuming it's a living trust, which I assume it is, then it's just going to be the individual. So if the trust is just, well, if it's a trust, well, that could be just you. But if it's you and your spouse, same thing. You're looking at 300,000 combined, or 200 individual, or $1 million in net worth. So it's almost like a pass through situation when it comes to figuring out the accreditation.
Okay. Is there any limit on how many LP or GP can be in an LLC?
No, although I'll just throw out the number. I mean, at some point, if you've got like 2,000 investors, you're required to go public, but I haven't seen anybody come anywhere close to the 2,000 limit.
Oh,
But you
I
can have
didn't
an
know that.
unlimited amount really of accredited investors. The limitation's really on the non-accredited, which don't apply in this particular deal. But with non-accredited, it's 35, but with accredited, it's basically unlimited.
So you could have 2,000 investors putting in a lot less money or something. That would be a lot
Yeah,
to manage.
yes, it would be.
Yes. Okay. As a limited partner in LP, is it necessary for me to have my own LLC?
That's a great question. It's really an asset protection question. I don't want to necessarily give you advice specifically, but your follow-up question has to do with privacy. So one of the things you can do if you don't want anybody else really knowing who you are, what you're up to, it might be nice for you to create some kind of I would actually suggest maybe Wyoming is a good jurisdiction because you set up a Wyoming LLC. It's pretty private. This particular investment is in Texas, and so you are already owning a piece of a Texas LLC that has outstanding asset protection. So from that perspective, I would say it's not necessary. Now, if you were in a different syndication and you were, it was a California LLC or a Georgia LLC or something like that, maybe from an asset protection standpoint, you might be better off for sure doing an LLC. Here, though, you asked the question about is your name available in the public anywhere? The answer to that is no. Your name's not going to be in any public record, but it is going to be in the operating agreement. It's going to be somewhere in the documents. And so if you want privacy there vis-a-vis the other members, you may want to look into getting some kind of a private company so that your name isn't showing up on the cap table. It's just some LLC.
So if it is in an LLC, you choose to do that, does it qualify in the same way or does it have different?
Yeah, so generally LLCs, it's in order for an LLC to be accredited, all of the members of the LLC need to be accredited. So the same
Okay.
thing. Yeah.
Is the income from a syndication tax advantage? Oh, we already did that, right?
Do that one, yeah.
How many opportunities are there for non-accrediteds? Do they go fast? We don't have any in this particular one. We filed as a 506C, but generally it's in a 506B, it would be 35, right?
Yeah, I
Non-accredited.
think they're asking how many opportunities.
Oh,
I don't know if that's more for you. Like, when is the next
oh,
506? When is the next time the non-accredited can get in, Kathy?
yeah. I was confused because I had legal advice from somebody else, and that's so confusing, Mauricio. There's so many different attorneys with different opinions, but one had told me that if we had filed as a 506C, it would be very difficult for us to go back to the 506B, which we used to do, allowing the non-accredited. And then you said, no, you can go back and do it. So
Well, yeah, not in the same deal. I mean, I wonder if they're
not in
talking
the
about the
same
same
deal.
deal.
No,
Yeah,
in the
but
next
no,
deal.
but you can absolutely go back later on. So if in 6 months from now or in the next deal, you say, hey, I want to do that as a 506B, you can absolutely do it. It creates some potential issues that we have to look at, but there's certainly no prohibition against that.
Yeah, because the idea was, okay, now I've gone out and advertised, and now are these really new investors that I had a pre-existing relationship with, or was it because of the 506c? That's
Yeah.
at least the way it was.
Yeah.
But yes, when we do come out with a 506b, I imagine it would go very quickly, but we will give you plenty of notice. Regarding tax depreciation, there is not depreciation until a property is placed in service, say as a rental. If the property is inventory held for sale, there's no depreciation on the property.
Is that a question or a
I
statement?
think it's a statement.
Yeah, I mean, again, I'm not a CPA, but yes, I mean, obviously, it gets put in, it's going to be placed in service upon the date that it closed. So it's going to be sometime here in 2025 that it's going to get placed into service. But yeah, the inventory, like I said, I'm not a CPA, so maybe this person is
Yeah,
a CPA and is giving us
yeah,
some
she is. She
heads
is
up
for
on that.
sure. And she's been very protective of us over the years, and she's awesome. So I think it's just basically there's no general answer. It always depends on the business plan of the project. So in some of our syndications where we're not holding as rentals, we're like Ridgewater, for example, in Oregon, we're not holding those as rentals, we're building them and selling them. Then it's not treated as a rental property. You don't get the depreciation. You are actually taxed as a builder, because you're a partner with the builder. So again, you always make sure that you take your documents and present them to your CPA so you really understand the tax consequences. Some CPAs may not understand it, but there is usually a tax section within the PPM that will help you see how any syndication would apply to your specific situation. And it also depends on which money you use. If you use IRA money, if you are borrowing, wherever the money's coming from, it may be taxed differently, and the state that you're in. So there's lots of questions to ask your CPA before you invest. But that is why the government is a little bit less protected for us accredited investors, because they assume you make more money, so you'd be able to afford to get the counseling that you need from your CPA and your attorney. Okay, where can I get the PPM doc? You want to share that?
Yep. I'll put it, we could put it in the chat, but if you go to Wild Pines on our website, it's a syndication. When you click on it, it'll bring you to the main page, all the PPM documents, description package, business plan, etc. is all on that page.
We have another tax question that we have to be careful about answering because we're not CPAs, but Lenora's here. She'll help us. If I'm investing 50% in an IRA and 50% outside of an IRA, will I still qualify for the tax benefits, i.e., owning a property? This is a perfect example of what I just said. These are two different sources of money, so they're going to be treated differently. In fact, the paperwork has to be filled out for each because they're separate. So, just depends. Depends. Lenore, I wish you were here with your speaker on. Anything you want to say about that, Mauricio?
No, just that they technically are two separate investors. So you're gonna have two separate subscription agreements. And just to show you how old I am, and it used to be, and I think they've changed it now. But first of all, it has to be a self-directed IRA. So you're gonna, assuming that's already happening, you're gonna have to move your IRA to a self-directed. But in the old days, the custodian for your IRA was the one that actually had to sign. I understand that that's relaxed a little bit now. You can actually sign on behalf of your custodian, but again, check with your IRA, make sure you're following their rules and procedures. But technically, if you put in 100 grand and it's 50 from the IRA and 50 from you individually, those are going to be two different people, two different K1s, two different entities.
Great question. Any recommendations for a CPA who's qualified to provide advice on syndications? In general, as long as you're a real estate investor, you want a CPA who specializes in real estate, and hopefully, along with that, they understand syndications. Hall CPA, HALL CPA does our fund our accounting, so they definitely understand it. But I would say any of the CPAs on our website at realwealth.com under resources would have that knowledge. And we got Anderson Advisors and anyone else, Mauricio, you recommend?
I mean,
KKOS.
yeah, I mean, Provision does all my stuff, and they're pretty sophisticated on syndications as well.
Provision. Okay. Okay. Will we be able to access this presentation later? It is being recorded, and
Yes,
yes.
we'll be sending it out in an email. So
Okay. So the deadline for this particular investment in Wild Pine is the end of the month. So it takes a few days to review the documents, to run them by your CPA and your attorney, and then wire your funds, and your funds have to be in by the deadline. So if you have any questions at all, Paul is so great about answering your questions and taking phone calls, talking about your specific situation, or at least explaining how he underwrote this specific deal. It was very conservative. And Paul, I think that you just explained, but in what ways were you underwriting it more conservatively than, say, we've seen others do?
I think the main one's one with the construction loan rate. We had a 9.25 and we're at 7.75. And even the LTV percentage, we had it like 70%, and we got 75% loan to value. So right there, instead of putting everything at that higher level, we put it lower, which, as I mentioned, it's going to reduce the amount of interest we need to carry. And even another big one's the percentage of increase year over year. You'll see in a lot of syndications, people put the 3, 4, 5% increases year after year after year, when that's not accurate. Where there's negative years sometimes. There's years at 6 or 7%. We kept it at 1%. Historically, San Antonio shows a 3 to 4% increase. It
In rents.
yes.
In rents, yeah.
In rents, yes.
Mhm.
In previous years, it did shoot up to like 14% and 7%,
Yeah.
right after COVID, which isn't, you can't expect that every single
That's not
year.
normal. Yeah.
So we played that conservative, and even in the expenses category, we have the warranty and there's a builder warranty, but we threw in additional expenses that hopefully we won't need when we start leasing it and managing it. So that will obviously increase the NOI, yearly NOI as well. So there's a lot of other examples, but this being our first deal in San Antonio, we sort of wanted to play it safe and not sell something that we don't think we could achieve the returns on.
Great.
One quick comment too on the IRA. I think it was Stephanie who asked about the IRAs. IRAs take a while, so if you're gonna use IRAs, you should probably move as fast as possible, because IRAs just
May take a
hopefully you
long
already have
time.
a self-directed, but just getting the self-directed, opening up a self-directed doesn't take time, but transferring the money, the IRA who's relinquishing the funds really don't have much of an incentive to release the funds ASAP. So there's going to be a drag between that time. So it might take a couple of weeks for that to happen. So I would highly encourage you to start that process right away, if that's what's, assuming it's not already in there.
And I do want to answer this question. Is the spelling correct on the URL? We just have a brand new website that was really launched yesterday. And I did type that in, and I don't know if that's coming up. So one of the easier ways to get to the page right now, and forgive us, it's a lot launching a new website, realwealth.com. You just go to the Invest tab and scroll down to the bottom, and you'll see Group Investments. I think we should have that at the top, though, don't you think, Paul?
Yeah.
Yeah. So sorry if that is if you're having any trouble getting to the page, we'll make sure Amy knows about that. But again, the easiest way that I just did, realwealth.com, go to the Invest tab, and you'll see Group Investments in the drop down. That'll take you right to it. All right. I think that's it. Let's see. I'm self-directed invested already, but I wanted to add more money, but outside my IRA. Just love Kathy. Oh my goodness. Love you too. Ah, happy to be doing this. All right. Well, I think that's it. Thank you, Paul. Thank you, Mauricio. Sorry, I just went running with the slides at the beginning. I'm like, where is everybody? And I think it was on my side. I couldn't see you. So it looks like I'm here on my own, which is funny. But anyway, would definitely rather have the attorney talk legal stuff than me. So Mauricio, thank you for all you do for us and our investors in your way of simplifying complicated topics. Polly, thank you for all you do in protecting our investors and your very thorough underwriting and oversight. And thank you all for joining us. Have a wonderful evening and hope to see you around soon. Bye-bye.
Thanks.